Welcome to the Broken Pie Chart Podcast, episode 343. I'm your host, Eric Moore. With me this week, special guest, New York Times bestselling author of The Wealth Ladder, Nick Magguilli. Nick and I sat down for about a 35-minute conversation. It's a great conversation, a lot of insights from his book, and we get into some other stuff as well. So enjoy that. After that, I'll come back and we're going to talk about the Fed, what's changed, what hasn't changed, the future of interest rates and mortgage rates too. So all that and more. All right. So this week we actually have a guest on, Nick Magguilli. He's the New York Times best-selling author. He wrote Just Keep Buying, his first book, COO at Ritholtz Wealth Management, the author of the blog of Dollars and Data. And Nick, we're going to talk about your latest book, The Wealth Ladder. And by the way, New York Times best-selling author, that's not going to get old anytime soon.
Yeah, I appreciate it. And that was for The Wealth Ladder. So it's been very surreal, all the positive feedback I've gotten. Thanks for having me on.
Yeah, no, thanks. I appreciate you taking the time. So I kind of, I really enjoy this book. And I'm just, a lot of times I'll give recommendations and I'm just going to recommend it. Like if you haven't read this, you should buy it. And what you did was, I think it was really smart. You took some of the survey data, and I think the Fed brings out that survey, and which tells a story on its own, but then you built a narrative around it. And I think it really makes it tangible for the reader. So congrats on that. I mean, what gave you the idea just to take that data and turn it into a book?
So the data I really wanted was in chapter 10 in the book. And I put it much later in the book because even though I really love it as a data nerd, I don't think every single person's going to be as into it as I am. And that data is showing wealth mobility over time. So saying, hey, if I'm at this point, and I basically take wealth and I break it into 6 levels, and we can kind of talk about those levels in a minute here. But the main idea here is like, if I'm in level 1 today, in 10 years, what's the probability I'm going to be in level 2 or level 3, et cetera, right? And so that was the data I really wanted. And that was kind of why I wanted to write the book, just to get that data and talk about this as a concept. And then I said, you know what, that's great for me, but I'm going to put that later in the book for kind of the data junkies, people that actually want to read through the whole thing. But then I took this idea of this framework of the wealth ladder, which uses kind of a 10x difference in wealth for every single level. And I said, hey, given this, like, what can I talk about in terms of income, in terms of spending, in terms of investments, and so forth? And so that's what the framework became. And really, it's like it's a dynamic guide to thinking about financial decision making, right? Because what I think a lot of financial books do, even my first book, Just Keep Buying, did this as well, was we try to provide a one size fits all solution. Like all you got to do is this. And I think the truth is it depends on where you start, right? If you have less than $10,000 in wealth, which is what I call level 1, the things you need to do to build wealth are very different than if you have, $1 million in wealth, right? Because the things you need to do to get out of level 1 and kind of get to level 2, et cetera, are going to be very different from someone who's already kind of made that journey and now they need to preserve, or maybe they're trying to go to 10 million, et cetera, right? And so I think thinking through those decisions and realizing that at different stages in your life and different stages in terms of how much wealth you have, you're going to make different decisions. And that's the big takeaway of the wealth ladder.
I've heard some people say, well, and I'll just ask you this. I think the way you did the levels, and you should definitely get into that and explain that, was a good way of doing it. And some people said, well, they're so wide. But what I like what you did is you sort of gave tangible examples of what getting into each of the levels of wealth did for you. So maybe kind of explain the levels, but then where I'm going with this. It's kind of the restaurant, the trial, that type of stuff. So talk about that.
So there are 6 wealth levels. Level 1 is less. And by the way, this is all net worth, and let's just use household net worth. So, you and your spouse, if you have a spouse, et cetera, take all your assets minus all your liabilities. That's your net worth. Level 1 is less than $10,000. Level 2 is $10,000 to $100,000. Level 3 is $100,000 to $1 million. Level 4 is $1 to $10 million. Level 5 is $10 million to $100 million. And then level 6 is $100 million plus. And so if you actually look at the breakdown of wealth across those levels within the United States, about 20% of households are in level 1, about 20% are in level 2, which is 10,000 to 100,000. About 40% are in level 3, that's 100,000 to a million. That's what I would say is like the middle class in the United States. About 18% are in level 4. That's 1 to 10 million. And then the top 2% is level 5 and 6. So it's a very small percentage in the upper levels, and especially level 6. There's like, I think 10,000 households in the entire level 6, which is a very, very small number of people. And so once you have these levels, and some would say, oh, well, aren't these arbitrary? You're using a 10x scale, like a logarithmic scale for this. And like, yes, it's arbitrary, but it's very useful because I've seen a lot of people talk about the levels of wealth over time. And the truth is, I don't know any of them. Like they're very hard to memorize. They're very hard to be useful in terms of different metrics and way of like talking to other people about it. Because if your level 1 is, less than $18,000 and level 2 is 18,000 to 63,000, right? If I do all these arbitrary things, like, yes, that might be slightly better on fitting the data, but now you've lost a lot of the usefulness of the framework, right? So for example, what you were talking about with these different types of freedom, in the first chapter of the book, I talk about spending money. And I say, well, how does the wealth ladder affect your spending decisions? And I came up with this rule called the 0.01% rule. And what that means is you take your net worth and you divide by 10,000, or you multiply by 0.01%. And that is the amount of money you can kind of splurge on, like on a daily basis. So if something costs less than 0.01% of your net worth, then don't worry about it. That's kind of the main idea behind that rule. So for example, if you have a net worth of $100,000, if you apply the 0.01% rule, that gives you an amount of $10, right? 100,000 divided by 10,000 is 10, right? So you take $10. If you're like, oh, well, I don't know if I should buy my coffee today. It's like $7 or whatever. It's below the $10 limit. Don't worry about it, right? You can do that once a day and not worry about it. Now, I'm not saying you should do it once a day or anything, but it's one of those things where if you're trying to make these decisions, I say don't worry about things below 0.01% of your net worth, right, on a daily basis. And so once you use that, if you follow this rule, getting to back what you're saying, we can then say every wealth level has a spending category. So for example, level 2 is what I call grocery freedom. So by the time you're at the end of level 2, by the time you have about $100,000 in net worth, you can kind of buy what you want at the grocery store. You don't got to worry about the prices. You can kind of just get what you want. By the time you're in level 3, and at the end of level 3, you have something called restaurant freedom. So you can kind of buy what you want in restaurants, right? Besides maybe the expensive wine list, you can kind of get what you want. Right. Level 4 is what I call travel freedom. So that's $1 to $10 million in wealth, which would correspond to a daily spend of $100 to $1,000 at the high end. And that's where like, hey, I can go on a vacation. I don't have to worry about, how much something necessarily costs. Now, that doesn't mean you can fly private. That's a whole separate conversation. But for the most part, you start to get more and more travel freedom as you go through level 4. And it goes from there. And so the main idea is like, these levels might seem arbitrary, but they actually map pretty well into very common spending categories that people spend money on.
Yeah, I mean, I think it makes it tangible. It's like something that people can. I really like the way you did it because, and I found this, and you're pretty open about towards the end of the book. You talk about your own sort of journey in the wealth ladder. But I remember like at some point I had to give myself permission to spend money as I kind of climb the wealth ladder. Like, yeah, it's okay. You can upgrade here. You can. So it sort of gives people permission. It is the 1%, the 0.01%. Is that kind of, can somebody actually say, well, okay, if I have $1 million, I can do, whatever it is per day times 365? Or is that just a general framework? Like I should be okay if I'm faced with a decision at one point. Like here's kind of a guide to do it. Does that make sense?
Yeah. So I don't recommend using it daily. Like in theory you could, and where that comes from, if you multiply your wealth by, if your wealth were to grow by 0.01% every single day for a year, that's about 3.7% per year. So this is kind of like the 4% rule in disguise. And I'm not recommending that someone spend this every single day. I think your wealth would stay stagnant if you were to do that. So I'm not recommending that. However, if it's like every once in a while, everyone makes spending decisions on the margin, right? No one is like, there's no poor person that's like at the Ferrari dealership, right? They know they can't afford it. Like people know kind of what they can afford and what they can't afford. It's everything on the margin. Like, can I afford this one thing, or do I need to feel guilty about this thing? And so, as you said, it really is a way of trying to give yourself permission to spend more over time. And the reason I really like the rule and using the wealth ladder for this is because it allows you to spend more after you've built the wealth. after you've shown the financial discipline of saving, investing, whatever you did to get the wealth, not just income. I'm talking about wealth, right? This is like saved assets of some sort, whether that's in a home, whether that's in your checking account, whether that's stock portfolio, whatever it is. You've now demonstrated financial discipline, and the question is, what do you do next? Can I spend more as a result? And that's where I say the answer is yes. As your wealth goes up over time, you get more and more spending freedom. You get, the purse loosened, so to speak, so you can spend more. So that's what I really wanted to do, because I was trying to find a way to solve the lifestyle creep problem. And the lifestyle creep problem is basically most personal finance gurus, experts, whatever you want to call them, they will always say, oh, no, you can't spend more. You got to keep your spending the same over time and then just save the rest and get rich. And that's fine and all, but I really think that's not the point of life. And you should expect your spending to go up over time, especially if you have a family, if you want to live in a nicer area, et cetera. If you work really hard for your money and you really are like, hey, I really want to enjoy my life. Like, I think your spending should go up, but it should only go up with wealth. It should not go up with income necessarily.
Well, you make that distinction in the book. And I like that you did that, because sure, if you have no income, you're just spending down your assets. Well, that's a totally different exercise. Or if you have no assets and you have income. So I think that's an important point. You make that. But I mean, maybe you just talk about the difference between income and wealth, how you framed it in the book.
Yeah. So I think the idea here is that income is much more fickle than wealth. Like, you can have a very high paying job, things are going well one day, and God forbid you get laid off, you lose your job. Now it's like, wow, that thing that was paying you a lot of money is now at zero. And then you have to go and find a way to get back some of that. If you can't get the exact same job in the exact same industry, et cetera, you might not be able to get that back right away. Now, of course, can your wealth go down? Yes, but is it going to drop by 100%? It's very unlikely unless you're concentrated in one security or one asset that goes to zero, right? So most people aren't like that, right? And so even during, the financial crisis in 08, worst case scenario, you were 100% invested in US equities with all of your net worth, you would have been cut in half, which is terrible, but that's the lowest point during one of the worst financial crises in US history. So someone who was diversified would not have seen such a decline. And so that's the thing I try and think about is income's fickle, wealth isn't. So if you have a very high income, that's great and all, but you need to turn that income into wealth. And then once you do that, that's showing the discipline, then you can spend more, et cetera. So that's the thing I try to focus on. You need to grow your income because that makes it much easier to save money. But once you've done that, if you don't save the money, then you can't spend it, right? And that's where I think the 0.01% rule comes into play.
You talked about chapter 10 as sort of the genesis of the idea for the book. How mobile are people? I mean, you've got some great examples of over 10 years, over 20 years, but how likely is it that somebody who is, and I guess age plays a part in this too, but they're in one cohort, how likely is it they get to, if they're in level 2, do they get to level 4? Does that happen?
Yeah. So I'll summarize some of this data from some of the tables in the book, but obviously you have to get the book to see all of them because there's a lot. I could talk about, well, if you start in level 1 and you go to what percentage go to level 3 within 10 years, right? Or if I start in level 4, what percentage go to level 5 within 10 years, et cetera, right? So just overall though, about 24% of households will be up either one wealth level or 2 wealth levels within the next 10 years. So 21% are going to be up about 1 level within 10 years, and about 3% will go up 2 levels within 10 years, no matter where you start. So agnostic of where you're starting, right? Now, over 20 years, it's a little bit higher. So over a 20-year period, about 32% of US households will be up 1 wealth level, and about 5% will be up 2 wealth levels over a period of 20 years, right? So that's just in general. So you're like, okay, if I'm in this level now, within 10 years, all else equal, there's a 1 in 5 chance I'm probably, or 1 in 4 chance I'm going to be up at least 1 wealth level, right, in a decade. And it does matter where you start, because if you're in a certain wealth level, it may be more or less likely that you're going to end up in another wealth level. And so I have these tables in here which show the starting wealth level on the rows, and then the ending wealth level vertically across the columns. And you can see, okay, what percentage are that start in what level, end where. And the big takeaway there, though, is that most people end up staying in the same wealth level over time. That doesn't mean that they didn't build wealth. Once again, these are wide ranges. So, for example, if you're in level 4, you might start at $1.5 million. A decade from now, you're still probably likely to be in level 4, but you probably built wealth. You're probably higher than 1.5 million. but you still are in that level. So that's why the level changes are so big, because it shows like kind of a big lifestyle change that tends to happen when someone moves from one wealth level to another. Now, of course, it's not this discontinuous break. It's not like when you have $990,000 and then you have 1.01 million, like your life absolutely is transformed. That's obviously not true. But in general, as you kind of move across these levels, you have these bigger lifestyle changes that can occur.
Do you find, and you relied on a lot of data, and I think the data tells a story, like I mentioned at the outset. I wonder though, thinking about level 4, somebody 1 to 10 million, do they even need to get to level 5 or 6? And I was thinking about this, and yeah, sure, they could like try and put all their money into NVIDIA. I'm not saying that's a good thing to do, but they could try 10x or 20x or 5x, and that's a way, but it's almost like an expected value calculation where, oh, I could be in 5 or 6, or I could be in level 1 or 2 again, and I don't want to be in level 1 or 2. Like, do people even? Have you thought about that at all, or gotten any feedback on that kind of point?
Yeah, so that's exactly, part 3 of the book. I discuss all of these things, which is like, okay, here's how to climb the wealth ladder. If you are in level 4 and you want to get to level 5, here's what you would need to do. And if you are in level 5 trying to get to level 6, here's what you need to do, etc. But that is the bigger question, is like, at what point do you stop climbing, and what are the trade-offs associated with doing that? Like, for example, to get to level 5, in general, besides being a celebrity, athlete, entertainer type person, you generally have to start a business, and it's going to be mostly entrepreneurs in that level, and they're going to either have started a valuable business and they got a lot of income from that business, or they over a long time, or they sold that business and a very large exit. That's another option that they could have, right? There's also those people that join a startup very early, get a lot of equity, and then that thing becomes one of the most valuable companies in the world. For example, NVIDIA. Like, there's a lot of people that made it into level 5 over $10 million just because they were early in NVIDIA and they got this equity, and then NVIDIA became the most valuable company in the world, right? So these are the type of examples where these types of things can happen. But that's how it happens in level 5. And to get there, though, it takes a lot of work, and that's the truth. And so you starting your own business, going out, joining a startup, there's risk there. A lot of these companies don't end up, going public and you make a bunch of money. So because of that, you're right that you can end up falling down the ladder as a result of something like that. So I do think it's a good question to ask. And it is something I bring up in the level 4 chapter when I'm talking about this level. It's like, you need to decide, do you want to go for level 5, or do you want to take your foot off the gas and kind of chill out a bit? And that's where we can kind of get into a discussion on what, maybe some of your audience might know is called coast fire, which is the idea that like, hey, you don't need to save any more money until retirement. You're good. You can kind of just coast until you get to retirement because you've saved up enough previously that with even very conservative market growth, you're going to, have enough to cover yourself in retirement. And so I think more people are choosing something like that, where they're like, hey, it's not worth it for me to keep working and doing all this. I can take a step back and maybe do consulting or something on the side, or have my side hustle, or take a much less stressful job where I make less, but I end up having so much more free time, and maybe my health's better and I have better relationships. And so those are the kind of trade-offs that I ask people to think about in level 4, especially as you get deeper into level 4.
Totally tangent, but FIRE, of course, is, what is it? Financial independence, retire early, right? That's the acronym.
Yep.
And like Coast Fire to me makes sense, because you've got what you've got, and you say, maybe somebody's in their 50s or 60s or 40s, but let's say 50s or 60s, and they're like, okay, the marginal dollar I put into my investment or my 401k, like, it's not going to move the needle. And you make that point in the book. But the FIRE, the 20-year-olds living in a van, showering at the health club to save every little dollar. To me, they have the benefit of time and health, and not doing things for so many years sort of assumes they're always going to do it. I don't know if you have any thoughts on FIRE. It's a tangent, we can move on from it, but I'm just curious.
Yeah, I think it's funny. I think one of the things people don't think about with FIRE is actually, let's imagine a 25-year-old with $1 million in net worth. And let's just say and a 65-year-old with $1 million in net worth. And let's assume they're just both in a portfolio, just to keep it very simple. Let's assume they're single. There's no liabilities, no family, whatever. It's just two individuals. One's 25, one's 65. And if I asked you, who has more financial freedom, the 25-year-old or the 65-year-old? Now, you're going to be thinking, well, the 25-year-old's better off, right? Because they have 20, they already have $1 million and they're 25, right? They're way ahead of their peers, right? And I would say that's correct. They are better off relative to their peers. But who has more financial freedom? It's easily the 65-year-old. And why is that? Because the 65-year-old made it through 40 years of life. They covered all their liabilities, all their expenses, everything, all the food they ate, where they lived. They made it to 65. So that $1 million only has to last them, let's say, another 25 years. The 25-year-old, all else equal, is going to have to work. Otherwise, that $1 million is probably not going to last them until they're, 90 years old, right? It's very unlikely that $1 million is going to last you from 25 to 90, but it's much more likely that $1 million can last you from 65 to 90. So I know people talk about FIRE and like, oh yeah, these people, they, save enough money and they just wait. But I think there's a lot of risk there. And there's also a lot of, you have to hope that the market does all this stuff. If we have another, lost decade, you could see a lot of people that were in FIRE come out of retirement. And I read about these things all the time, and they don't happen too often, but people come out of retirement because it's like you try and plan and hope for the best, but at the end of the day, like the world may not turn out the way you expect it to turn out. So that's kind of my thinking on it. And I'd rather say like, I much more support Coast FIRE. I think Coast FIRE is the best FIRE that's ever been come up with, because it's not about cutting all your spending. It's about like finding something you love to do and doing that and making some income from it, because, we need income. We have liabilities. There's other people we're going to have to support in our lives. It's not just us. And so when you realize that, I think it's much better to have a little bit more safety, a little bit more redundancy in your financial life. And if that means you have to save a bit more, work a bit more, that's fine. But find something you enjoy working on. That's probably more important and more valuable than just saying, oh, well, I don't have to work anymore. But, I don't see the value in that philosophy.
I also don't know what you do for health insurance for 40 years, but anyway, let's move on from this.
Yeah, especially in the US, that's correct.
Yeah, that's right. In the I'm thinking about level 4. You have this great little thing, and what is it? What's the island nation in the Central Pacific off Australia? You give this great example.
Nauru, yeah,
where they made their money one way, and I think your point was it's the subheader. What got you there will get you there. And they decided to, invest in things that they really didn't know anything about. What are some of the mistakes maybe that you found either through the data that kind of illuminated themselves just in your research, or just anecdotally that you can share? People who've like, look, if you're level 4, you're in a pretty good spot.
Yeah. So I think the biggest risks in level 4, obviously over concentration, making bad investments. And it's not just one investment that's going to kill you. I mean, obviously it depends what percentage of your portfolio, but it's unlikely it's one investment. It's the collection of how you invest, right? So if you're like most people, you're in index funds, you're in like target date funds, whatever it is, you're probably going to be fine, right? It's very unlikely that that's just going to all go to zero, right? But if you're like, oh, I'm going to make these crazy bets on these individual stocks, and all those stocks are correlated in some way, they're all tech or they're all something else, like you've done very well recently. I don't know if that's going to continue forever, right? And I think, and people will say, well, I don't know if that's true, Nick. Well, like look at what happened in 2022. All those bets that looked so great in 2021, many of them turned out to be not as great in 2022. And I'm not saying that's going to happen again. We don't know, but it looks like I'm seeing echoes of 2021 today in some ways, right? And so I think thinking through your philosophy and how you do that's important. The other big wealth killers in level 4, besides risky investments, is divorce, things like that. That's one of those things where I don't care who you are. If the end of your life or some point in your investment career you get cut in half because of a divorce, that's going to be very debilitating. So that's another reason why I say like, hey, don't go and chase level 5 if your relationships aren't in a good spot, because you could go chase money while I'm trying to take care of your financial security, and in the act of doing that, you actually end up hurting your own financial security, because you end up losing your relationships, you get divorced, and now you're worse off than if you had never just, done that in the first place, right? So I like to think about things holistically, and I think those are the types of things where people overlook them. I think, those people are very wealthy and very driven, I think, are underinvesting in their health. They're probably underinvesting in their relationships, among other things. So that's the thing I would say to look out for in level 4 in particular.
Chapter 11, Nick, you go into, it's really, does money buy happiness? And I've sort of thought, the way I think about it is money it creates opportunity, but it may or may not get you happiness. And I think you kind of showed some conflicting data that you researched, but I mean, it kind of goes into your last point. Like if you're chasing wealth and everything else is just getting messed up in your life, like the money is irrelevant. You're certainly not going to be happy. But I wonder if you just touch on what you found there, if anything kind of gleamed itself.
Yeah, so most of your listeners probably heard of the original Kahneman Deaton study, which was, I think it's after $75,000 in income, not wealth, and income, your happiness doesn't increase anymore. And so then a guy named Matthew Killingsworth looked at the data again, and he kind of did a separate survey, and he's like, no, my data shows that like happiness keeps increasing with more income. And so they're like, okay, what's going on here? Like your results conflict with mine. What's going on? And so they dug into the data and they found that the Kahneman Deaton study was actually, their measure was misspecified. And so they weren't measuring happiness, they were measuring unhappiness. So it's kind of a weird way to say it because it's like a double negative, but they found that unhappiness doesn't decrease after $75,000, right? Like you can have more and more income, and that doesn't necessarily prevent unhappiness, right? Which is a very weird way of saying it, but that's kind of what their measure found. And so, long story short, they went and they looked at the data again, and Killingsworth was right. And so, if I had to summarize the research where it is today with money and happiness, it's this: if you're poor, more money is likely to make you happier. If you're happy, more money is likely to make you happier. But if you aren't poor and you aren't happy, more money's not going to do a thing. And I think that is the big takeaway from this. And so those people who are in level 4 who are like, oh, I'm just not feeling great about life. If I just had, another few $1 million, then I would be set, then I'd be good, and then I'd be happy. I have some bad news for you. That's not the case. I can guarantee that's not the case. Because the data shows, like, if you're not happy there with all that money you already have, you're not going to be happier with a few extra million. Right. And you might think that now, but it's been shown. Now, of course, if you're in level 1 or level 2, maybe, especially level 1, where like you're having to struggle just to make ends meet and all that. Yeah, more money is going to make you happier. I think that's undeniable. Right. But at some point, you're going to have enough where all your basic needs are covered and everything. And the data shows it doesn't make a difference. So if you are happy and you're doing well and you're not even thinking about money, ironically, more money would make you happier. That's the funniest part. Like the people who aren't thinking about like, oh, am I happy? If they're just enjoying life, they have money, they're doing great. More money is actually going to make them even happier, which is very weird. So it's all the people that are chasing the money as a source of happiness are actually not going to get the thing that they want, which is very ironic in this sense.
What would have been the, it's funny, you and I just met up at Future Proof and kind of the genesis of how we wound up on the podcast. But people probably come up to you and like Jack Schwager, I interviewed him a number of years ago, and he's like, I never know what part of my book people are going to come up to me and say, oh, I really like that. What's been your experience with people, just talking to you about either book that you've written?
Yeah. So with the Wealth Ladder, I agree with Jack completely, because you just never know what's going to resonate. And the reason why is because everyone's in a different part of their life. Everyone, once again, this is different wealth levels. So there's people that have come to me in level 1 that said, oh my gosh, this is so true. Like no one talks about this, but these things, like you really need to rely on your network, which is something I talked about in the book, right? And then people come to me in level 4 and be like, oh my gosh, this is exactly what I'm going through right now. And so because I had different levels and different things and ideas, in every level, I am able to connect with different people from different backgrounds. And so that's what made the book unique in that sense. And of course, it's not a one size fits all. It's like, if you're in level 4, this is the perfect, exact, great book for you. That's not it. I try and touch on the core issues. I may expand and write about that at some point, because I think level 4 is like probably the hardest wealth level to get out of. And we can get into that as well. But I think overall, it's just like, it's very interesting how different people just find different ideas interesting. And so you can be talking about a lot of different stuff. And I've gotten feedback all over the book. Some people love the spending chapter. Some love the investment chapter. Some love that mobility chapter. There's data nerds that have reached out to me like, man, this data is really cool. I love this. I'm like, yep, that's exactly why I wrote it, for people like you. So yeah, I agree. It's all over the place.
I want to ask you about your blog. So of Dollars and Data, and maybe if we have time, I'll come back to the book. Mm-hmm. I first was turned on to your blog. It was, and this goes to the whole thing we were just saying. You never know which article, like how people get it, but it was something that was forwarded to me the very end of 2019 or 2020. And at the end of a decade, you sort of do if the prior 10 years or prior 20 years was a return of X, here's the XY scatter plot. And what you did was, you may not even remember this, but it was like a 10-year future growth rate based on 20-year prior return. Mm-hmm. And the point you were making, you weren't making a market call, but you probably remember there were Vanguard data, maybe Goldman Sachs said, oh, we think we're only going to have annualized, X amount, it's going to be lower. And on the scatter plot, it's like, hey, if the S&P only doubles by 2030, it would be an outlier to like the downside. And I think that was the first article I saw, and I remember we sort of wrote about it on our blog, and I referenced it. But you're basically, as a data person, you're not making predictions. You're just saying, okay, let me look what happened. Let me show you. And okay, it's just interesting, right? So I don't know if you remember that at all. You probably don't, but.
Oh, no, I remember this chart very well. So,
okay.
Because I think it's a very interesting idea, and a lot of people haven't talked about it, but it's like, hey, if you look at the prior year 20, the growth over the prior 20 years, inflation adjusted, because 2000 to 2009 was so bad, 2010 to 2019 was not enough to make up for, like, it was so bad that like any other historical period that was like that 20-year period had insane growth over the next decade. So as I said, I think it was like, I think Dow has to hit, I think the Dow had to hit 100,000. I think that was like, okay, Dow's going to hit 100,000 before 2030. People said like, that's an insane thing. And I think it's actually on track to do it. Right. So it's like, it's at 50,000 or 46,000 right now. And we're obviously in 2025, but like, it's not unreasonable to see that would happen. Right. So we will see if that comes to pass, but those are kind of when I was looking at the data in 2020, I was like, I know this seems crazy, but I think this is doable. Right. And so you look at that type of stuff, and and of course the future may not be like the past, and this could be a completely different ball game. But I think people were so bearish at that point that like even saying the S&P 500 would double from that point seemed crazy. And I think it's actually, I'm not sure if it has since then. I have to look. Let me actually look now at the data, and I can tell you.
I think it's like 2.2 times or.
Yeah. So even if I go back, let's go back to, let's say 2020, the beginning of 2020 is when I probably wrote that.
Yeah.
And so at the time, let's say S&P 500 was 3,200. It's actually, funny enough, it's 6,600. So it's basically doubled in the 5 years. And I said, to be online with history, we'd have to do a 4x. And everyone's like, that's insane. That'll never happen. Well, guess what? We're already doubled, and of course, this is not inflation adjusted, right, with the doubling. So we're not exactly doubled. We're a little less than that. We're probably 1.5, 1.6. So we're close to 2x. But like in 5 years, we almost got to this very, very conservative estimate I had already. So I think that's one of those things when you think about that, you're like, oh, wow, actually, the data is, historical data is more useful than people think it is. Yeah,
no, for sure. Yeah. And you write long form articles on there, and, you can tell you put a lot of work and research into it. So of dollars and data, I would definitely check that out if you haven't, especially we have a lot of advisors, industry people, as well as retail investors who listen, but it's worth a look. Nick, anything, I know we're coming up on time soon. Anything you wished I would have asked you about the book that I'll just let you kind of free roll for a second. Anything you wanted to point out on the book that maybe I forgot to ask you?
One of my favorite things is for the level 4 people in particular. Since you brought that up, I'll just expand on that a bit. So the subtitle of that chapter is What Got You Here Won't Get You There. And so the idea is the strategy you follow to get into level 4 is very different than the strategy you need to follow to get out of level 4. And I already talked about this a little bit with business ownership, but just do the math and it's very illuminating. So for example, let's say you have a portfolio of $1 million today, and you're earning 5% a year after inflation, and you're saving $100,000 a year, right? So you're saving $100,000 after tax. That's a lot of money, right? So how long would it take you to get to 10 million? And the answer is 28 years. This is 28 years of grinding and saving 100K, of earning 5% a year on average, right, after inflation, and you already have $1 million, right? So this is after you already saved up $1 million, which can take people, a lifetime, sometimes many decades. And so even after doing that, to get to 10 million, you have to save, do this again for another 28 years. So when you do the math on this stuff, it goes to show that the typical, good 9-to-5, solid paycheck, investor, a diversified investor is not going to get to 10 million, right? Without some other factor, which is like either a large income exit from a business, or they take a lot of risk in their portfolio and their portfolio does well, et cetera. So I think it's just a cool idea to think about. And then you realize, oh, wow, yeah, the strategy to get to one place is very different than the strategy needed to get to another place.
There's almost like 4.5. Like I feel like there's a 4.5 level in there, that 5 million. Although you make the point, I don't know, does your life really change that much? I guess it depends on the age, but maybe there's a 4.5. I don't know.
Yeah, and so people have debated this, which is fine. Yeah, does your life change that much between, let's say $3 million and $8 million? I mean, probably not too much. I know you're saying, well, Nick, that's $5 million I can spend. The problem is most people don't. If you actually look at people who have wealth, very few of them spend down their wealth. They're just living off the income, right? So if you're doing the 4%, let's say you're earning 4% treasury bills, hypothetically, right? On $1 million, your income is 40K. On 3 million, it's 120. Okay, 8 million is going to be quite a bit more than that, $320,000. That's a lot of money, but still, like 320 versus 120 in terms of income, like, yeah, that does make a difference, but maybe not as much as people think. It's not like you're flying private. It's not like you're, having caviar every day, right? So there are some big changes you can make. You can, have more travel freedom and things like that, but I don't think the changes are as large as people think they are.
Well, Nick, this has been great. I'm a fan of the book, and as you can tell, I've read it. I think I listened to it first, and then I wound up rereading some of the sections. You were nice enough to sign a copy for me, so in preparation, I was sort of reading these. So I think it's like, this is a book I feel like a college should make required reading in their finance class. I think it's good, and I like the way how you break it down. There's sort of something from everyone in there. So, Nick, I appreciate you coming on today. It's, again, New York Times bestseller, which is awesome. Congrats on that. What the Wealth Ladder, Just Keep Buying, and Of Dollars and Data. Nick, I've enjoyed this. Thanks again for coming on.
Thanks for having me on, Derek. Appreciate it.
All right. Thanks again to Nick. Great conversation. Enjoyed having him on, and definitely get the book, The Wealth Ladder. All right. The Federal Reserve did something this week. They lowered interest rates. They hadn't been doing anything, and they finally did it. Of course, the administration's been calling for lower rates for a while. And I remember seeing some data when there's a gap between the first cut. Did I say raise? I meant cut. The first cut, and you have this gap of, I don't know how many months, and then they cut again. The forward historical S&P 500 returns have been fairly good. I mean, who knows what's going to happen going forward, but, history may not repeat itself, but it often rhymes, as one author once said. So what does it mean for the future of interest rates, at least October, December? There's an October 29th meeting. There's a December 10th meeting. And the probability is about 92, 93% for another quarter point cut in October. And it's about an 87% probability of another, like an additional 25 basis point cut. You go to the January meeting, and it's about a 45% probability. You don't get the third cut until at least priced into the Fed funds futures. And we know these often change until, looks like the April meeting, and then July. It's just about that fourth cut. So the effective Fed funds rate right now is 4.08. That's the effective rate. So 4.25 is the target rate. So does that mean we're going to get more cuts? I don't know. I mean, Powell seemed to signal that. We'll see if some of the economic data continues to cooperate. I said it, I think, last week on the show. While the rate of inflation, the rate of change on inflation hasn't necessarily been going down, I would say it is sort of plateaued for a while. It does seem, though, the Fed has thrown out some of the targets. I mean, the 2% target's only been in effect since, 2012. I think it was New Zealand who first started that, and they were talking about it in the 90s. But the reality is the Fed funds rate was more than 2.25, less than 1.75 for a lot of that time. Meaning, you think about a 50 basis point window, it didn't really spend that much time in there. So we'll see what happens. The other thing I would say is people have been asking me, and I know a few folks who are saying, look, I'm buying a house. Should I wait to buy a house? I'm going to wait to sell my house, because when the Fed lowers rates, people will be able to afford more, better rate on a mortgage, which brings their payment down, all else equal. And of course, it never is. So mortgage rates, anyway, they were coming down. If I look at the 30-year, the bank rate 30-year national average for 30-year mortgage, 6.37. And it's been trending lower. It's been trending lower. I mean, it was 7.06 at the end of May. If you go back to January, it was 7.41. So that has been trending lower. And of course, the 10-year Treasury has a very close correlation with the path, let's say, has a correlation with 30-year mortgages. And there's a typical spread. I'll get into that in a second. But 4.12, 4.13 was the U.S. government 10-year Treasury yield. And, I mean, it's certainly, if I zoom out and I look at a monthly chart, not as high as it was in 23, not as high as it was in 24. And for you technicians out there, just looking at the monthly chart, and I do like looking at monthly charts because you kind of reduce some of the noise. It's forming a little bit of a wedge, and the technicians amongst you know what I'm talking about, where you have lower highs and higher lows. And a lot of times what happens is when you get this compression, lower highs, higher lows, you sort of have that pennant that forms, a wedge or a pennant, call it a pennant maybe. And a lot of times the price resolves one way or another, or it just kind of treads sideways for a bit. So I'm interested to see what happens in the 10-year yield. But as that has come down, mortgage rates have followed. Now, I've said for some time that you could have the Fed do nothing. You could have the 10-year Treasury stay exactly where it was, but just the spread, the typical spread, could just compress to more of a historical norm. So I know I previously did some work on this, and I used the FRED data, the Federal Reserve Bank of St. Louis, 10-year Treasury against 30-year mortgage. And the period I chose, I think it was around 170 basis points. I recently in Bloomberg learned I was like, why don't I just do this in Bloomberg? Because Bloomberg has this cool page where you can view a spread. It's the HS function, I believe. And so you go in there, and I said, let me look at the monthly. And what I did was I looked at 25 years. Yep, 25 years of monthly data. And what you find is that the spread between the rate on the 30-year mortgage and the yield on the 10-year Treasury has been pretty wide. So historically, and just to give you an idea what it is right now, it's 224 basis points and some change. Meaning when you see a 10-year yield, and the 10-year yield is 4.12, I'll call it 4.13, you add that to 224, and you come up with 637. 6.37 is the national bank rate average on the 30-year mortgage. But then you look and you say that, well, the median spread is 174 and some change. So if we went back to the median, and there's an average too, the average, I'll just tell you, is 184, 185. So if we just went back to the 25-year average, and you said, well, I'm going to take 185 against the 413, it's about 5.98. In other words, the Treasury could stay where it is if it went back to the long-term average. If it went back to the long-term mean, then you're looking at, what did I say, 413 plus the 174, and that brings you to about 5.87. And that gets interesting because a lot of people said, well, if rates got down closer to 5, maybe that would open up the lending market again. Now, we looked at some data last week. I think Sam Rowe had posted something from Goldman Sachs saying that, look, I mean, most people have mortgages below 5%. And certainly most people have mortgages below 6%. And there's still a big cohort that has mortgages even lower than that. And that's one of the reasons why some people have said, well, if I'm in a house, maybe I'd like to move, but I have to move and do a larger mortgage, unless, of course, you're taking equity and you can pay cash. But what I've seen in the data, and there's a nice chart. I may post this on the ziginvestments.com site when we post the podcast. I think I'll post this chart so you can see it. And I mean, look, at one point there was 343, 344 basis points difference, meaning the 10-year plus 3.43. And that was in 2023. But when you see this chart, you'll see is that the spread has been coming down since that high in 23. The spread has been lowering. And if it just lowers and maybe you get a little cooperation on the 10-year, we could see mortgage rates come back in a bit, which I think would be welcome news for a lot of people. But we'll see, though. I'll let you know when I know. Another question I had and I've been getting this question a lot, is, aren't we too high of a valuation? Isn't the market overvalued? And I would say, like I've said the last couple of months, yeah, I mean, on a forward basis, you're 23.42 forward earnings, meaning the market's at 66, 64, 36. And the estimate for the forward 12 months, according to Bloomberg, is 284.50, which factors in about an 8.62% growth rate. Sales per share is estimated about a 4.78% growth rate, which I think is above the long-term average. But you look at the earnings per share and the sales per share, and you do the math there, and it's now projecting a hair over a 14% net profit margin, which, if that comes in, that would be one of the higher ones. I think that would set a record probably. I could be wrong. I'd have to go back and look at the data. I feel like it was 13.6 at some point. So when people say, well, like, why is the market going up? In the long run, earnings matter. Like if you just had a chart of earnings on the S&P 500, and then that's all you had, you would say, well, this goes up and to the right. And when it doesn't, if it stays flat or if it declines, I mean, you would expect the market to decline. But the market trades on a multiple, meaning there are times when it trades at a greater multiple, meaning how many times future earnings. There's times where the multiple compresses. In 23, when we had, I believe it was 20 or 22 or 23, earnings, I mean, they were kind of flat, but the multiple declined. And the market going lower was basically a multiple contraction. Sure, I mean, interest rates, the reason of why people traded the market at less of a multiple is one thing. And it just does that. But it is interesting. And that is why you own, I mean, we're big advocates of just owning the index. We tend to buy the index, hedge it, buffer it, do some other things to take out some of the risk. But in the long run, I mean, you have these companies that are in there. You have a collection of companies. And by owning an index, you are basically buying something where members will come in, members go out, companies merge, they come out of the index because they get bought. We saw that with, Walgreens recently came out of the index. So look, I mean, earnings estimates are, at least right now, we'll see. These are estimates only. We don't know if the market's actually going to come in or not on these estimates, but I mean, so far, so good. So long-term earnings matter. And what's hard about this, I mean, we're getting towards the end of the year, believe it or not. We'll do a preview show or a prediction show, and I'm sure we'll look back at what our predictions were last year. It doesn't change anything of what we do, but you'll get predictions. And I always tell people, when you are making a prediction, a 12-month prediction of where the market will be, I just want you to think about this. In order to really nail this, you have to guess. So imagine it's December 31st and you have a forward 12-month earnings estimate. Well, if you're picking for the end of the year, you're actually picking what December 31st, 2026, its forward 12 months earnings estimate will be then. So that's sort of what you're predicting. And then even if you get that right, then you have to get the multiple right. How many times those forward earnings will the market be trading at? And this is why it's, I mean, much easier just we've come up with this phrase recently, and people try and figure out the markets. We just like to buy it and we hedge. Takes away some of the guesswork of when to get in, when to get out. But in the end, I mean, earnings matter, and I think the last earnings season was pretty good. All right. The other thing, there's a proposal, and this has been floated before, and there are some European markets. And what I'm alluding to is the idea of only coming out with earnings maybe every 6 months. And this is not new. There's been talk about this before. And one of the reasons that this has been floated before is the idea of when companies have to manage to their earnings and report earnings every quarter, it doesn't give them breathing room, and it doesn't give them time to make changes and then let things happen a little slower. They're always sort of managing to the number. And the idea is that if you do it every 6 months, or I've seen some people say, well, why don't we just do it once a year? Then the CEOs, the boards, the executives, these corporations can actually take a step back and do long-term planning, like really think about how the business is being run, doing things that will impact the business, but they may not come to fruition or bear fruit immediately. So I don't know. We'll see what this is. Selfishly, I would miss the quarterly earnings reports. Like, to me, when it's earnings season, and especially when you had that big week with Microsoft and Apple and everybody, and then you do the earnings calls, and then you get Tesla, or you get Nvidia late. Like, I would miss that. And I think it's, there's an argument to be said, more transparency. Companies can always make adjustments, write down things in a quarter, and just message it. This is what we did. So we'll see what happens with that. I saw something that the SEC is evaluating it, considering it. But some data that I saw too, who was this by? It might have been JP Morgan. I wish I could remember. It was something that was passed to me. I can't place it right now. But what they did was, I think they looked at one of the European indexes, and they looked at the multiples on companies that only report every 6 months versus quarterly. And I don't think there was that much of a detriment. But certainly for people who are fans of the market, who follow this stuff, we would miss the quarterly earnings reports. Just be honest. All right. That's it for this week. I hope you really enjoyed the interview with Nick. I thought it was a great, the half hour went by so quick. Could have stayed on for 2 hours, to be honest with you. So I already gave my recommendation, but it's The Wealth Ladder by Nick Magguilli. And I also, there's a couple things I don't know if I'm going to watch. I started to watch the Charlie Sheen documentary on Netflix. It's only 2 episodes, so that's interesting. But some things popped up. There's what is it called? Black Rabbit? Jason Bateman. So there's a new show on Netflix. I'll give a pre-recommendation on that. Looks kind of good from the preview. My wife started watching it. She said, I'll like it. So that's sort of queued up. And that's it. All right, everyone. Thanks for listening. We'll be back next week. Take care.